Hello, I'm Nathan Kubik, and thank you for joining us for the end of the first quarter Transform Wealth Capital Markets Review. I hope that everyone is doing well and staying healthy. Many of us are back in the office, though we are continuing to social distance and will continue to have virtual meetings. Our dedicated team looks forward to the day that we will be able to meet with you in person, and are hopeful that day will come sooner than later. In this outlook, we will be focusing on the current market conditions, economic impacts from COVID-19, the market's response, what lies ahead of us, and how we are positioning. So let's get started. In the first quarter of 2021, the equity markets continued their rally for a fourth straight quarter, with the S&P 500 and NASDAQ reaching new record highs. Forward-looking economic indicators are continuing to improve. Corporate earning levels are improving and are forecasted to continue this trend. The vaccine rollout is continuing to ramp up, and 2021 looks promising from an economic standpoint. That said, there are still risks to the economy and to the markets. And while this recovery is clearly underway, we do need to continue being thoughtful from an investment standpoint moving forward. In this outlook, we will be diving into what we find to be the most influencing factors and what those mean for where we are today and where we go from here. In the last quarterly outlook, we considered vaccine rollout expectations. This slide from the last outlook represented the three likely phases of the vaccine rollout. Based on the most recent data, we appear to be slightly ahead of this schedule. With vaccinations continuing to increase, we are beginning to approach the targeted levels of herd immunity. This can be seen in the chart on the right. While the US is not as far along as the United Kingdom, we are having one of the fastest rollouts and are continuing to ramp up meaningfully. Additionally, it is important to consider the age demographics of those that are vaccinated. Looking at the national numbers, we see that almost 30% of those over the age of 18 have been fully vaccinated, and that 47% have received at least one dose. Those over the age of 65 who have received at least one dose are now at almost 80%. Additionally, Colorado appears to be rolling out vaccines at the same pace as the rest of the country. And while we have seen an upturn in cases after spring break and cities reopening, it is important to see that hospital admissions have really not spiked in a corresponding way. These slides support the continued reopening of the economy, which we are also seeing through economic indicators. Here, we consider the unemployment rate. As you can see, unemployment has dropped to the 50-year average level. While we have not reached the record lows seen pre-pandemic, it is our expectation that these levels will continue to fall as the economy continues to recover. The markets are certainly pricing in a strong economic recovery, and most analysts are forecasting a greater than 6% GDP growth rate for 2021. From the bottom, the S&P 500 has rebounded incredibly quickly and has far surpassed the pre-pandemic market highs. Now, while the markets are certainly pricing in a rosy period ahead, there are still some concerns that we need to consider. One of those areas is that of the debt our country has incurred. Here, we consider the $3.3 trillion deficit we incurred in 2020 and the expected $3.4 trillion deficit for 2021. This is an issue that all countries are dealing with, and there will need to be a corresponding balance sheet move to address this deficit. While the economic growth we are experiencing will certainly help, there will likely be some changes to our tax code to offset this spending. The two primary areas of focus for these tax changes lie within the business and the personal tax codes. On the personal side, President Biden's tax plan proposes increasing income tax levels for those earning more than $400,000. It also contains new limits on itemized deductions, the elimination of step-ups in basis for assets at the time of death, and the moving of capital gains and dividend tax rates to ordinary income for those earning more than $1 million. This last one does not appear to consider the fact that a corporate tax rate of 28% plus a 39.6% federal tax rate plus a state tax rate will result in the government's taking 65% of the company's distributed earnings. Now, there is much that has to happen for any of these changes to take effect, but it is likely that we will need to address these items with you and potential impacts to your financial plan in the coming months. On the business side, Biden's tax plan proposes the reversal of the Trump tax cut, which will increase the corporate tax from 21% to 28%, which also has some meaningful implications to the equity markets. As we've discussed in the past, equity market valuations appear quite high right now. The equity markets have and continue to look forward to what earnings look like once we come through this pandemic. Given the expectations of economic growth and corporate earnings growth, it is possible that these valuations are warranted and that earnings will grow into these valuations. In truth, without the conversation of a corporate tax increase, we wouldn't find too much concern in the current market valuations. However, we need to consider the implications of a corporate tax increase. Looking at the light blue circle on the left, we see that the markets did take into account the implications from the previous tax rate cut. At that time, the markets priced in the additional earnings that would come from the tax cut, and valuation multiples increased. When the known tax cut occurred, those additional earnings dropped to the bottom line, and valuation multiples fell as expected. It is possible that the opposite could occur with a tax rate hike. It is also possible that the markets won't care. But if corporate tax rates are raised, valuation multiples for many companies will increase to concerning levels. Therefore, our focus within our investment strategies needs to meaningfully consider valuations and the impacts from a potential tax hike. Now, not all companies have the high valuation levels we just considered. On the left chart, we look at the valuation multiples of the largest 10 companies in the S&P 500, depicted in green, and we compare that to the rest of the S&P 500 companies, depicted in gray. As you can see, those 10 largest companies have significantly higher valuation multiples than the rest of the market, and they make up 27.4% of the entire S&P 500. In our strategies, we do not own all of those holdings, nor do we weight the ones we do own as heavily as they are represented in the S&P 500. In addition to the meaningful disparity in valuations of the top 10 holdings, there is also a meaningful disparity within the rest of the companies within the index. Here, we can consider that disparity. In this chart, after eliminating the top and bottom quintiles of valuations, we can see that there is still quite a spread in valuations within the equity markets. The green line shows us the median S&P 500 price to earnings ratio. The gray area shows us the range of valuations for that middle 60% of the index. As you can see, some companies have valuations that exceed those of the tech bubble, but a majority fall in the range of where we have been these past few years. The big takeaway here is that while there are certainly companies that we feel are in bubble territory, there is still a meaningful pool of companies that still look relatively attractive from a valuation standpoint. And these are the types of companies that we are focused on. From a style perspective, in the fourth and first quarter, we have seen value stocks outperform. Growth had been in favor for several years prior, and there are several reasons for this shift in leadership. Part of the reason is the economic recovery and a shift in focus to some cyclical companies. Another is the disparity in valuations and the move of value companies' valuations back to a normative level on a relative basis to that of growth. And the last is that a number of growth companies were assigned value company valuations and have since moved up the style spectrum. The big question that we need to ask is whether this change in style leadership will last or if growth will resume leadership. In the chart on the left, we are looking at relative price to earnings ratios of growth companies versus that of value companies. It is apparent that from a relative standpoint, value companies had become cheap compared to growth. It can be seen that this particular differential is narrowing towards a historically normative level. While not quite at the historical average, we have moved back to the differential that we were in prior to the pandemic. As such, we are not seeing the same opportunity in style investing that we saw 6 months ago. To that end, we remain more neutrally allocated between growth and value companies. Should we see growth resume leadership, or reasons that value may stay in favor, we will allocate accordingly. In the meantime, we will be more focused on sector, subsector, and underlying company attribute exposures. In the first quarter, we did see sectors that are more cyclical in nature outperform others. With rising oil prices, energy stocks did begin to recover, followed by financials, industrials, and materials. This is a bit of a reversion from the prior year, and part of the reason for this comes from the valuation dispersion discussion that we just had. Similarly to the style discussion, we are watching to see if growth-oriented sectors like technology and consumer discretionaries will resume their leadership later this year. Here we look at our core equity model. Two of the top 4 performing sectors, financials and materials, are our largest overweights, while we maintained a market weighting in the other top sectors of energy and industrials. Moving forward, we continue to focus on sectors that appear to be better positioned than others for this coming market cycle. Additionally, we are focusing even more closely on the subsector weights and the individual securities fundamentals. A similar story can be seen in our dividend equity model. Financials, industrials, and materials are our overweights here. This strategy has an inherent tilt towards large cap value, and this attribute did boost the performance in this model over the past few months. While it is not clear if this trend will continue, we do believe that these types of companies have stronger fundamentals and that their valuation metrics also remain relatively attractive. Like the core equity model, we also continue to hold a defensive portion within this model to the buffer cap strategy. As we are in a time period of incredibly low yields, the dividends associated with these companies, along with their strong fundamentals, should continue to look attractive and entice buyers as we move forward through 2021. I will note that any tax changes do have the potential of causing us to shift our focus here, but we currently feel well positioned within this space. On the bond side of things, we have seen a meaningful move in the interest rate curve. While we remain in a somewhat difficult interest rate environment, the longer end of the yield curve has moved upwards. Here, we consider the Treasury bond curve at 3 different time periods. The green line represents where we were in August of last year, and the blue line represents where we are today. The 10-year Treasury bond yield has moved from a 0.51% yield to a 1.74% yield, which is a substantial move. Bond yields typically spread off of the Treasury curve, and we are seeing better rates in the bond market as a whole. And while rates are better, we are not overly excited about where yields are today. Our stance is that there is reason to continue being patient and a bit defensively positioned as we move forward in the expectation that rates can rise further. One of those reasons is the budget deficits we discussed earlier. The increased debt levels will increase the supply of bonds out there, which in turn can have an impact on bond prices and yields. This can be seen in the chart, which shows us the current and forecasted balance sheet of the Federal Reserve. This increase in bond offerings could create a more attractive yield environment as a simple result of supply and demand. Additionally, the Federal Reserve has been purchasing a number of different types of bonds, which has resulted in their desired intention of keeping interest rates lower. It is expected that this excess demand will be tapered in the not-so-distant future. In other words, with the increasing federal balance sheet, the Fed cannot artificially hold interest rates down indefinitely. As depicted in the chart on the left, it is forecasted that the Fed will reduce their bond purchases by about 50% this year. This reduction in demand does create the possibility of interest rates increasing. But the Fed will be watching the impact closely, and it is unlikely that they will allow rates to rise too dramatically. Another reason that we feel it is prudent to remain patient and defensively positioned within bonds is that of inflation. While there is not currently any tangible reasons to expect a spike in inflation, it remains an important factor that we need to be aware of. With the amount of money the Fed has pumped into the system, there are risks of inflation. Should inflation increase, bond yields will also increase in turn. There are certainly areas we are witnessing inflation, such as home prices, building materials, oil, and other commodities. But to date, these have had enough offsets to balance inflation. We continue to keep a close eye on indications of inflation, but are not yet seeing cause for concern. Given these factors, we feel well positioned with our fixed income strategies going forward. To conclude, we hope this presentation has been helpful in understanding some of the market's moving pieces. We also hope that we've been effective in showing you some of our underlying rationale for our current positioning. While we continue to be encouraged by the improvement in the economic data and in forecasts, there are always risks and unknowns within the markets. We remain focused on these potential risk exposures and are prepared to reposition again should clarity of information shift risk exposures further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented today. Take care, please stay safe, and we look forward to speaking with you soon.